Now, it's my great pleasure to introduce Mark. He doesn't need any introduction, but I'm just going to give you a quick snapshot. He is widely regarded, and deservedly so, as one of the outstanding central bank governors of his generation. He had a career in investment banking at Goldman Sachs. We won't hold that against him, to be followed a few years later by his appointment as Governor of the Bank of Canada, where he had an extraordinarily successful career in overseeing the Canadian economy. He was appointed to the Financial Stability Board in 2011 and remains their chairman. And as Governor, of course, he's also chairman of the PRA, our principal regulator. He has a number of other great qualities. One I have not seen: he completed the London Marathon in 3 hours and 31 minutes a few months ago. But in the short time I've known him, I have to say his personal qualities shine through. His great sense of public service, his warmth, and his sense of humor. So with that, I introduce Mark Carney.
Thank you very much, John. That extremely generous introduction and extremely generous invitation. It is a tremendous honor for me to be here. I'm going to give you a speech without a joke, I'm afraid. So, charge your glasses and prepare yourselves. Because I'm going to speak about a serious subject with a serious group of people who have done more than anyone else to address the issue. But let me first say that I'm very grateful to Lloyd's for this invitation, to John and to Inga. This honor of speaking at the first city dinner in this magnificent eponymous room. And to speak to Lloyd's, which is the bedrock of the UK, in many respects, global insurance industry. Since 1688, Lloyd's has, in the great tradition of the city, served both the UK and the world, providing protection against the perils of the age, helping enterprise, and I underscore enterprise, to thrive. From its origins, marine insurance, the Lloyd's market has evolved constantly to meet the needs of a rapidly changing world, a point that John just made. The first excess loss reinsurance was created here. Modern catastrophe cover was born with your decision to stand by the policyholders after the San Francisco earthquake. Lloyd's pioneered aviation insurance, and with eyes constantly on the horizon, Lloyd's has remained at the forefront, and as you said, John, the innovation at the heart of Vision 2012. Today, you're insuring new classes of risk in new parts of the world, from cyber to climate, from space to specie, from Curitiba to Chengdu. And you're doing so in market conditions that are as challenging as any in the last 20 years. This need to manage emerging mega risks is as important as ever. Because alongside major technological, demographic, and political shifts, our very world is changing with profound implications for insurers, for financial stability, and for the economy. And I'm going to focus on those risks, as John referenced. I'm going to focus on those risks from climate change this evening. Now, there's always room for scientific disagreement about climate change, just like any other scientific issue. But I've found that insurers are amongst the most determined advocates for tackling it sooner rather than later, and it's little wonder, while others debate the theory, you deal with the reality. Since the 1980s, the number of weather-related loss events has tripled, and on an inflation-adjusted, as you would expect from a central banker, on an inflation-adjusted basis, insurance losses from these events have increased from around $10 billion per year during the 1980s to around $50 billion annually over the past decade. But the challenges currently posed by climate change pale in significance compared with what might come. And the far-sighted amongst you, and we know this from a survey we've just done, the far-sighted amongst you are anticipating broader global impacts on property migration, political stability, as well as food and water security. So the question is, why isn't more being done today to address it? Well, the classic problem in environmental economics is the tragedy of the commons. And the solution to that lies in property rights and supply management. But climate change is a tragedy of the horizon. And we don't need an army of actuaries, even though we do have an army of actuaries in the PRA under Andrew's leadership. We don't need an army of actuaries to tell us that the catastrophic impacts of climate change will be felt beyond the traditional horizons of most actors. It will impose costs on future generations that the current one has little direct incentive to fix. In other words, future costs beyond the business cycle, beyond the political cycle, and certainly beyond as well the horizons of technocratic authorities like central banks who are bound by their mandates. After all, the policy horizon for monetary policy extends out 2 to 3 years. And for financial stability, it's a bit longer, but at its extreme, it's out to a decade, which is the extreme of the credit cycle. In other words, once climate change becomes a defining issue for financial stability, it may already be too late. And that paradox, that tragedy of the horizon, it runs deeper because risks are, of course, a function of cumulative emissions, meaning that early action is less costly. The desirability of restricting climate change to 2 degrees above pre-industrial levels leads to the concept of a carbon budget, which is an assessment of the amount of emissions the world can, quote, afford. And such a budget highlights the scale of reaction tomorrow necessary for inaction today. Now, those actions will be rightly influenced by policy choices that are the responsibilities of elected governments advised by scientific experts. And in 10 weeks, representatives of 196 countries will gather in Paris at the COP21 summit to consider the world's response to climate change. Those governments, in effect, are choosing whether and how to pursue that 2-degree world. And so the question, given that introduction, the question is, what role for finance? Well, earlier this year, the G20 finance ministers asked the FSB to consider how the financial sector could take into account the risks that climate change poses for our financial system. And as chair of the FSB, I've hosted meetings, including one last week, where the private and public sector have discussed those risks and what might be done to mitigate them. And I want to share some of those views after providing some context looking at the example of the insurance industry. Now, there are 3 channels through which climate change can affect financial stability. First are physical risks, or the impacts of physical risks, familiar to virtually everyone in this room. The impacts today on insurance liabilities and the value of financial assets from climate and weather-related events that damage property or disrupt trade. The second are liability risks, or the impacts that could arise tomorrow if parties who suffered loss or damage from the effects of climate change seek compensation from those they hold responsible. And finally, transition risks, or the financial risks that could result from the very process of adjustment to a lower carbon economy. The speed at which that adjustment, that repricing occurs, is uncertain and could be decisive for financial stability. And there's already been a few high-profile examples, including in the last weeks, of jump-to-distress pricing because of shifts either in environmental policy or performance. One of my core points is that risk to financial stability will be minimized if the transition begins early and follows a predictable path, thereby helping the market, and I'd underscore the market, to anticipate a transition to a 2-degree world. So to draw out those points, let's consider the Bank of England's and the PRA's current approach to the insurance sector. As regulator of the world's 3rd largest insurance industry, the PRA is responsible for protecting policyholders and for ensuring the safety and soundness of insurers. Our supervision is forward-looking and judgment-based. It's risk-based and proportionate, tailored to different business models, and it considers both business-as-usual events as well as whether a firm can fail safely. While our mandate is to protect policyholders, many of whom are local, we are very conscious of the need to raise standards outside our shores. And Solvency II, for all its difficulties, is a good example. It is prudent but proportionate, and it's a directive that embodies the core principles of our domestic standards and embeds them more consistently across Europe and replaces a patchwork of regulation in Europe amongst your European competitors. Another example of best practice converging globally is the FSB's agreement last week on higher loss-absorbing capacity for globally systemic insurers, as well as its support for the IASB's completing its new insurance contract standard. So the UK insurance industry is well prepared for both of these developments as higher standards globalize. Now, of course, forward-looking regulation must consider the impact of emerging vulnerabilities on business models. And that's why the PRA has been working these last several months with regulated firms, including many of you in this room, to produce for DEFRA a review into the impact on climate change on British insurers. And that report, which has just been published today, concludes that those insurers stand exposed to each of the three types of risk that climate change poses to finance. It notes that the insurance industry here is well placed to respond in the near term, but it cautions that its ability to manage risk today doesn't mean that the future is secure. Longer-term climate risks could have severe impacts on you and your policyholders. Let me draw that out. The direct costs of climate change are already affecting insurers' underwriting strategies and accounts. For example, work done here at Lloyd's estimates that the 20-centimeter increase in the sea level at the tip of Manhattan, this increase since the 1950s, increased by 30% the insured losses from Superstorm Sandy. Beyond these direct costs, there's been an increase in indirect costs and market losses through second-order events such as disruption of global supply chains. And so insurers are therefore amongst those with the greatest incentives to understand and tackle climate change in the short term. Incentives that are sharpened not just by your commercial concerns as capitalists, but as John Nelson just alluded to, your moral considerations as global citizens. And your response, the response of Lloyd's, the response of the UK insurance industry, is at the cutting edge of understanding and management of such risks. Lloyd's underwriters were the first to use storm records to mesh natural science and finance in order to analyze changing weather patterns. So events like Hurricanes Andrew, Katrina, and Ike have helped advance cat risk modeling and provisioning. Today, Lloyd's underwriters, as you know, are required to consider climate change explicitly in all of their business plans and underwriting models. And your genius has been to recognize that past is not prologue and that the catastrophic norms of the future can be seen in the tail risks of today. So the combination of your forecasting models, a forward-looking capital regime, business models that are based on shorter-term policies, means that general insurers are well placed to manage the physical risks in the near term. But recognizing that, looking further ahead, there is a business model question. As these physical risks increase, they could challenge general insurance business models. Because without action to mitigate climate change, policyholders will begin to feel the impact as pricing and coverage adjusts, and this could pose wider issues for society, including whether to nationalize risk, as we've seen recently in this country. Physical risk from climate change will also become increasingly relevant to the asset side of your balance sheets. While the ability to reprice or withdraw cover mitigates liability risks, you have to be careful not to suffer from cognitive dissonance within your organizations, whereby the underwriting side moves quickly and the investing side moves more slowly. And that dynamic highlights this basic point around transition risks from climate change. This is a sector that manages almost £2 trillion in assets, matching liabilities that often span decades. So, while a given physical manifestation of climate change may not impact the value of a corporate bond or a share, key point is that policy action to promote transition towards a low-carbon economy could itself spark fundamental reassessments. So take that example of a carbon budget I used earlier. If you use the IPCC's estimates of this, it amounts to only 1/5 to 1/3 of the world's proven reserves of oil, gas, and coal, proven reserves. So if that estimate is even approximately correct, it would render the vast majority of reserves stranded, literally unburnable without expensive carbon capture technology, which itself alters fossil fuel economics. Now, the exposure of UK insurers, in fact, all UK investors, to these shifts is potentially huge. 19% of the FTSE 100 are natural resources and extraction, and a further 11% by value are in power utilities, chemicals, construction, industrial goods. Globally, it's similar numbers. Those two tiers of companies comprise 1/3 of equity and fixed income assets around the world. Now, that's the challenge. On the other hand, financing the decarbonization of the economy is a major opportunity for insurers as long-term investors. It implies a sweeping reallocation of resources and a technological revolution with investment in longer-term infrastructure at rates roughly quadruple those at present. What's clear is for that to happen, this cannot conceivably remain a niche or green sector. Now, there are a number of factors which could influence the speed of the transition to a low-carbon economy, including obviously public policy, technological developments, investor preferences, or the actual manifestation of physical risks. Now, from a regulator's perspective, the point isn't that the point is not that a reassessment of values is inherently unwelcome. It is not. It is welcome. But our concern would be a wholesale reassessment of prospects, if it were to occur suddenly, could potentially destabilize markets, spark a pro-cyclical crystallization of losses, and a persistent tightening of financial conditions. In other words, an abrupt resolution to the tragedy of the horizons is in itself a financial stability risk. And the more that we invest with foresight, the less we will regret in hindsight. And there are ways to make that more likely. The risks I've outlined do mean that financial policymakers have a clear interest in ensuring that the financial system itself is resilient to any transition that is hastened by policy decisions. And it's our responsibility to make sure that it can finance it efficiently. Now, some have suggested that we as regulators ought to accelerate this financing towards a low-carbon economy by adjusting capital regimes for banks or insurers. But our view is very clear. This is a flawed approach, or that would be a flawed approach. History has shown the dangers of using prudential rules for other purposes. Our proper role is in developing frameworks that can help markets to adjust efficiently. My core point is that a market in a transition to a 2-degree world can be built. And such a market has an ability to pull forward adjustment, but it will do so only if the information is available and, crucially, if the policy responses of governments and the technological breakthroughs of the private sector are credible. And that's why, following our discussions at the FSB last week, we are considering recommending to the G20 Leaders Summit that more be done to develop consistent, comparable, and reliable disclosure around the carbon intensity of financial assets. Such information would allow investors to assess risk to companies' business models and to express their views in the market. You know, there's a well-known dictum in economics, at least if you're an economist, it's a well-known dictum, which is Say's law, which is that supply effectively creates its own demand. And it means that the very act of producing new products eventually creates the income and profits that ultimately finance demand for those and other products. By analogy, a framework for firms to publish information about their climate footprint and how they manage their risks and how they prepare or not for a 2-degree world could encourage a virtuous cycle of analyst demand, greater use by investors in their decision making. And crucially, would also improve policymaker understanding of the sources of CO2 and of corporate preparedness. So a carbon budget is hugely valuable, but it can only really be brought to life by disclosure. Disclosure that gives policymakers the context they need to make choices and firms the ability to anticipate and respond to these choices. Now, let's be absolutely clear. We're not scientists at the Bank of England. We're not climate policymakers. There are a lot of uncertainties around these issues. And given those uncertainties, not everyone will agree on the path. Some will dispute those calculations of carbon budgets. Others might despair that there will ever be financial consequences of burning fossil fuels. Still others could decide that the stakes make political action inevitable. Point is, the right information will allow skeptics and evangelists alike to back their convictions with capital. It will reveal the valuations of companies that produce and use fossil fuels and how those valuations might change over time. It will expose the likely future cost of doing business, of paying for emissions, of changing processes to avoid these charges, and of tighter regulation. It will help smooth adjustment as opinions change, rather than concentrating them in a single Minsky moment. And crucially, it will allow feedback between the market and policymaking, making climate policy a bit more like monetary policy, where policymakers learn from markets' reactions and refine their stance. Now, the idea that better information can promote a more timely response is not new. Much the opposite. There's nearly 400 initiatives that attempt to provide such information. And in aggregate, over 90% of FTSE 100 firms and 80% of the global Fortune 500 participate in to some degree in some variant of them. Now, unfortunately, these existing schemes vary in their status, their scope, and their ambition. And the surfeit of initiatives and the fragmented disclosure that results creates a risk of getting lost in the right direction. So irrespective of field, whether it's in finance or science, the most effective disclosures are consistent, they're comparable, they're clear, reliable, and they're efficient. And meeting such standards requires coordination, which is what the G20 and the FSB are ideally placed to provide. The logical starting point is a coordinated assessment of what constitutes effective disclosure, an assessment made not by the public sector but by the private sector, by those who understand both what's valuable and what's feasible. So an idea is to establish an industry-led climate disclosure task force to design and deliver a voluntary standard for disclosure by companies that produce or emit carbon. Companies would not only disclose what they're emitting today, but also how they plan their transitions to the net zero world of the future. And this proposal, again, it's a variant on an older idea, a recent idea, where the FSB successfully catalyzed improved disclosure by the world's largest banks, many of whom represented in this room, at my table, in fact, surprisingly, improved disclosure by the world's largest banks following the financial crisis. And that effort, the EDTF, showed that how the private sector, the buy side, the sell side, the rating agencies, and the issuers, can radically improve disclosure, and they radically improve disclosure, and build market discipline without the need for detailed or prescriptive or costly regulatory interventions. So such static disclosure is a necessary first step. And there's two ways that its impact could be amplified. I'll say a couple words on them and then conclude. The first way is that governments, potentially sparked by COP21, could complement that disclosure by giving guidance on possible carbon price paths. Such a carbon price corridor involves, just as it sounds, indicative minimum and maximum prices for carbon. So even if the initial indicative price is set far below the true cost of carbon, the price signal itself holds great value by linking climate exposures to a monetary value. And the second element that could enhance this disclosure is to use stress testing to profile the size of the skews from climate change to the returns of businesses. And this is another area where insurers, and Lloyd's in particular, is at the cutting edge. Your stress testing technology is well suited to analyzing the tail risks that are likely to grow fatter with time. Stress testing, built off better disclosure and with a carbon price corridor, could act as a time machine, shining light not just on today's risks, but on those that may otherwise lurk in the darkness for years to come. So let me conclude. Our societies face a series of profound social challenges, political challenges, economic challenges, and John detailed them. They also face environmental challenges which link back to each of those. The combination of the weight of scientific evidence and the dynamics of the financial system suggest that in the fullness of time, climate change will threaten financial resilience and longer-term prosperity. While there's still time to act, the window is finite and is closing. Others will need to learn from Lloyd's example in combining data, technology, and expert judgment to measure and manage these risks. The December meetings in Paris will work towards plans to curb carbon emissions and encourage the funding of new technologies, but we'll need markets to work alongside them in order to maximize their impact. With better information as the foundation, we can build that virtuous circle of better understanding of tomorrow's risks, better pricing for investors, better decision-making by policymakers, and a smoother transition to a low-carbon economy. By managing what gets measured, we can break this tragedy of the horizons. Thank you very much, and thank you, John.